NRP Daily here on the National Real Estate Post with our dear friend, Barry Habib. I'm not going to do any mentions this morning. I don't think we need to, because I think we need to dive right into this. Obviously, our loan originators are kind of, got big eyes going, what's going on, man? Well, I'm hanging on. What's happening? So let's just dive into it. I remember you put out a message. I think it was this week, or it might have been last week. I can't remember, but it was saying, "Hey, watch the 10-year at 137." That's kind of what I'm looking at here, and kind of it went through that. And so there's a lot going on. You've got a lot to tell these guys. So let's just jump into it. What do you got for us?
Yeah, we said the 10-year Treasury looked like a good ceiling at 137. There was reason to believe. I got head fake thinking that 137 was actually holding, but then breaking above that, it got ugly, and it got ugly fast.
Yeah.
Looks like 160 on the 10-year is the next stop. There's a lot of things that help us at around 160. Right now with the 10-year, let's call it, as we speak here, 148. This now is, you and I talked about this, Frank. We've talked about this before. It starts to impact something called TINA, T-I-N-A. TINA. There is no alternative, T-I-N-A,
okay,
to the stock market. And that's what, going back to Ben Bernanke, and then you've got Janet Yellen and now Jerome Powell, all keeping the Fed funds rate so low, trying to keep interest rates low so that people invest money into the stock market, pushes stock prices higher, gives you what they call the wealth effect, and stimulates the economy. Well, that was in play when the S&P 500, the stocks within that S&P 500 were yielding in dividends about 2%, and the 10-year Treasury less than 1. People said, hey, I got to go in the stock market because I'm not getting yield here. Well, now, because stock prices have gone even higher, the yield on the S&P 500, because higher stock prices, the yield correspondingly goes down, just like in mortgages. When the price goes up, the yield goes down. So that yield is now down to 1.5%. And the 10-year Treasury yield has gone from below 1% to now up to almost 1.5%, break even. The 30-year long bond is at 2.29. So maybe there is an alternative. Now we think that 160, we've been talking about 160 for a while, is like, that's like the outside shot. Let's hope we stop before that. Unfortunately, doesn't look like we're going to, it looks like we're getting to 160. When we do, I wonder if that's a point after this big move up in rates, this big sell-off, if there's some sort of exhaustion there, and now we could start to see a turn of events to where we get some relief. I don't know how much relief, but it looks like that might be a very good marker. That was always the strong ceiling. We were hoping that 137 would hold. It unfortunately did not. And I've got some charts that we can talk about and look at too.
Yeah, let's take a look at those and see what's
all
going
right, because I think people want to know, when's this going to end? Now, look, remember that we are still in a really good place as far as rates go.
Yeah.
But as we start to look at where we are now going to go all the way back. Here's where we are right now on mortgage bonds. I took a long-term view, and this corresponds exactly. I'll show you.
So is this a year? Is that a year chart?
Yeah, a year that we're looking at right here. Thank you. Each one of these represents a day of trading. You take out all the craziness during the time when the lockdowns came and the Fed was going crazy. Here was the floor, and then we came right back to that floor right here. Just take out this. This was the insane period when the Fed was buying way too much, and then it leveled out here. But if you take this same line and you bring it all the way across, well, guess where it brings you to?
Where
we are right now.
Yeah.
So we are trying to hopefully see if this floor holds. If we break this floor, the next one is right here, is where that next level is. And while that doesn't look too far on this chart, it's 100 basis points in price, or about 0.25% in rate. Let's take a quick look at the 10-year Treasury. So as we show the 10-year Treasury now, here's what we talked about. Now the 30-year bond is at 230. We're at 147. Let's call it 148. Very close to the dividend yield on the S&P 500, currently giving an alternative, and the long bond may be a good alternative. But breaking above this 137 level, as you can see, we were actually faked out here, Frank. And we've had quite a string of correct calls on the market. I'll show you on mortgage bonds first. When you take a look at this for a very long time, I mean, we've called all the tops of the market here, locked at the very top of the all-time high. Patient did not do a lock for 5 weeks, locked at the all-time high, protected all the way down, all the way down, all the way down. And we had this fake out here. We thought this corresponded with 137 on the 10-year.
Got it.
That this looked to us like it was going to be a turning point. And we also had Jerome Powell speaking, saying, oh, we're going to keep buying. So all the cards looked in place for this looks like a good turnaround here.
Yeah.
So we suggested floating here, but we were wrong. We went back to locking here.
Yeah.
But for this one day here, we lost about 25 basis points, but we've done a lot of good in between. We were believing 137 would hold. So we go back to 137 on the 10-year. You could see that once it was tested, held. Even on Wednesday, this held pretty well.
Yeah.
But then the break above it convincingly here, that sent us into ugly land right here.
Yeah. So what's the thoughts on going forward then? Let's recap that real quick.
So the thoughts on going forward is likely gets a little worse before it gets better. But what we have to talk to our customers about here is that there's going to be some confusion, because just this week, twice during 2 testimonies, Jerome Powell, the Fed chair, said, we're keeping rates at 0. We're going to do everything we can to keep rates low. And the customer and the realtor hears this, and they don't have the benefit of seeing what's happening in mortgage bond land. So we have to remind people that the Fed funds rate is very different than mortgage rates. Fed funds rate can change every day. A mortgage is going to be in place with that same rate for potentially 30 years. So therefore, if there's inflation, and that's what's causing this, all this stimulus is going to cause potentially, we haven't seen it yet, potentially some inflation. And in anticipation of that, yields are rising.
I see.
Because on a mortgage that's going to be out there for 30 years, additional inflation eats away at the fixed payment you get. The Fed funds rate, they can change that every day. So they can keep it at 0 today, move it up tomorrow if they wanted to.
Yeah.
So it's very different. We have to explain that. Now, people shouldn't get on the sidelines and discouraged, because the housing market is still a great opportunity to create wealth. And there's so much equity in homes that debt consolidation can be huge. So look, overall, to answer your question, I think it gets a little worse before it gets better. Watch 160 on the 10-year. That to me seems like a pretty strong report. It looked like a strong report all along in 137, but we were hoping that 137 stopped us. It didn't. 160 looks like it should. And at that point in time, I don't know exactly how much they get better. We should have a little less heartburn.
Are there any inflationary type numbers coming out next week that might trigger something?
Well, as people are watching this, we would have just got, because we have to record this on Thursday, it's come out Friday morning.
Right.
Friday morning, the personal consumption expenditure report, that's the Fed's favorite measure of inflation, will be a very pivotal report. If you're watching this and the PCE comes, you'll probably come out at similar time at 8:30 a.m. Eastern on Friday. If you're watching this and you're seeing mortgage bonds do badly, it's probably because it was a little hotter than expected inflation, as reported in the personal consumption expenditure, or PCE. If the bond market looks good to you today, chances are that PCE was pretty tame and pretty calm. So this is a very important report, because inflation is driving all this.
I understand.
How
about the following week, going into Monday, Tuesday, Wednesday? Any other numbers popping up?
Yeah, it's jobs week. We get it. We're in March already by the time that happens, man. So we're going to get job report numbers, and that's always going to be important. Although right now, what's really driving fear in this market is all this stimulus is going to potentially result in inflation. Now, while that might happen, what we've seen proof of is that it's what's called transitory. It kind of hits, but then it wears off, and then we come back down to better pricing in better times.
Yeah.
Let's see. It might take a little bit for that to happen.
Okay, good stuff, Barry. Again, guys, the best way to keep your finger on the pulse of all this is obviously become an MBS Highway member. If you're not already, I'm sure most of you already are, but if you're not, long shot that you're not, I'm putting the MBS Highway logo down below this video. You can click it. You can try it out for 14 days for free, I believe it is. But you'll be kept up to speed in real time as far as what's going on within the bond market, interest rates, that type of a thing. So be sure to become a member if you're not already. So that logo will be down below. With that, Barry, thanks so much for all your insight. We'll see how things play out here, and we'll have you back next week just to touch base. Does that sound okay?
Sounds great.
All right. Well, you guys do us a favor. Leave us your comments down below. Forward this, share it, and subscribe in the upper right-hand corner if you're meeting us for the first time to get further updates from us and Barry. You guys have a great one, and we'll catch you later.